Hello and welcome to Stockwatch Live. Now, all that glisters may not be gold after all. It could turn out to be copper. While demand has never faltered for copper, the world's most widely used metal, concerns about the US-China trade war have hit its price. Copper has been trading 13% lower at just over $6,200 a tonne, hitting share prices in the mining sector and raising alarm about just what the fall in the price of the metal, often referred to as Dr. Copper for its ability to forecast global economic growth, is signalling to the wider market. However, a turnaround in the price of copper has seen mining stocks back in demand and has spelled good news for Anglo American, Antofagasta and Glencore, the mining giants whose share prices have benefited, and all three are due to post trading updates in the week ahead. First up is London-listed Anglo American, which a couple of months ago revealed it had pegged out a huge area on the edge of the Amazon rainforest in Brazil. The area, the size of Israel, is widely thought to be the site of a copper-gold deposit. Anglo said it has drilled 6 holes at the site, but wouldn't be drawn on further details back in July. Its chief executive did say early signs were encouraging, but he said he preferred to wait until the end of the year before giving any more away. So, now we're fast approaching the end of the year, investors will be hoping some more detail is forthcoming this week. If a huge copper find has been located, then that would be a godsend for the company, which almost went bust during the brutal price crash that rocked the mining industry in 2015-16. Since then, it's continued to scour the globe for new deposits to add to a portfolio that already spans platinum, diamonds, iron ore and coal, and that diligence may well have paid off. Back in January 2015, Anglo American shares sank to a low of 221 pence. Today, they're trading back around £17. Barclays Capital has reiterated its equal weight investment rating on Anglo and raised its price target to £18.50. Deutsche Bank says the shares remain a hold and has also lifted its price target to £18.50, while UBS remains neutral but has increased its price target to £18. Now, broker Goldman Sachs is far less positive on Antofagasta, which is due to give a trading update the day after Anglo American. It's just downgraded its rating to sell from neutral as part of a review of worldwide new copper projects. In a note, the broker said, "We believe the market continues to underestimate the lack of supply growth in copper and therefore remain positive on the copper price." So far so good. But it went on to say that when it comes to Antofagasta, a stretched valuation, relatively poor free cash flow generation versus its peers, and uncompelling growth potential means it's a sell. Its buy recommendations included Anglo American, BHP Billiton and First Quantum. Glencore, which is due to give its update on Friday, has already made it onto Jefferies International's buy list, but the broker has cut its price target from 450 to 440 pence. The miner is in the middle of a multi-billion share buyback programme. Last month, it increased the size of its share buyback by up to $1 billion. The announcement, which came just as the company neared completion of its existing $1 billion share buyback programme, saw the shares hit a 3-month high. They're still off their January peak of 415 pence though. UBS remains neutral and has cut its price target to 360 pence, while Morgan Stanley has upgraded its rating to overweight from equal weight and cut its price target to 390 pence. Finally, we end the week with a trading update from WPP on Thursday. It'll be the first we've heard from the world's largest marketing services group since Mark Reed was officially appointed chief executive. Always tipped as a favourite for the job, Reed had been jointly running WPP on an interim basis since Sir Martin Sorrell resigned in controversial and acrimonious circumstances back in April. These are certainly interesting times to be taking the helm. WPP has been struggling and last year reported its worst financial performance in almost a decade. But Reed has already insisted that the global holding company model isn't broken. He's rejected calls for a breakup of WPP, but said he will look at the sale of selective assets. Shareholders will be listening out for news on which of the assets he has in his sights. One possible is a potential £3.5 billion sale or partial sale of its research arm Kantar. And aside from keeping a close eye on Sir Martin, who began putting together a new advertising group called S4 Capital within weeks of leaving WPP, the advertising group faces multiple challenges in a rapidly evolving media environment, not least from the likes of Accenture and Deloitte, who are already stepping into WPP's territory, as well as advertising holding companies such as Publicis. who are offering advertising alongside their core services. Such is the threat from rivals that Ford Motor Company has recently appointed a competitor as its new lead creative agency. News of that hit WPP shares hard. Ford, which was WPP's largest client, has given the bulk of its business to Omnicom's BBDO agency and relegated WPP to Tier 2 advertising work and media buying. Ford had historically accounted for about 4% of WPP's sales, with creative fees likely to have made up about a quarter of that, according to analysts. Broker UBS said losing Ford could hit both WPP's net sales growth next year and prompt a restructuring of the creative business. But with Ford having announced the review of its ad agencies in November, the broker said the effect might have been priced in already. WPP shares are currently trading at the lowest they've been for around a year at £10.33. Well, that's all for this week. For more on the companies reporting in the week ahead, go to the Markets and Insights section at fidelity.co.uk. Thanks for watching.